Good morning from our global headquarters in New York. I'm Danny Berger, Manus Cranny on a well-deserved break this week. Welcome to Bloomberg Brief. Let's set your agenda. Tech tanks. Over $420 billion is wiped off global chip stocks after ASML slashes guidance. All about growth. Former President Trump defends his economic plan in an interview with Bloomberg. We'll bring you more from that exclusive conversation. And Morgan Stanley will wrap up a strong earnings season for the biggest banks on Wall Street. Strong Wall Street earnings couldn't save us, though, for yesterday. It was all about tech. We slipped from record highs yesterday. This morning, we're basically little change for the S&P. NASDAQ and Russell 2000 are stronger. ASML, though, still cratering in the Netherlands trade. It was this tech stock that led everything lower, including NVIDIA yesterday. Shows the risks of relying on big tech. When it comes to this bond market, yields also moving lower. We have oil moving lower, less geopolitical risk. That's part of it. Also partially led by UK bonds. Those are coming in. Sterling also dropping this morning below 130 for the first time since August after UK inflation coming in below 2%, setting the stage for more BOE cuts. So the risks are rising in the U.S., more uncertainties. And on that, BlackRock's Vasiliki Pachatouridi writes that we have more confidence owning duration in Europe bonds versus U.S. dollar bonds. Vasiliki joins us now. I'm pleased to say she's the head of EMEA iShares fixed income strategy at BlackRock. So Vasiliki, questioning American exceptionalism in bonds, why?
Good morning, Danny. Thank you for having me on the show. Indeed, we do have a preference for owning European duration, but I think the context in that is slightly different. I mean, we are expecting the ECB to cut rates tomorrow by 25 basis points, but that's obviously expected by markets. But I think what's interesting is going to be absorbing that pivot in their reaction function, right? So they're now moving into a monthly back-on-back rate cuts, accelerating the pace of cutting, and that puts them on a more dovish path. So that's good for owning duration in Europe. And then the reasons that you mentioned earlier around the U.S. I mean, not questioning the U.S. economy obviously is much more resilient at this point than the European economies, but it's more down to the uncertainty, policy uncertainty, political uncertainty over the next couple of weeks. And that's why we're more cautious and selective on U.S. duration, still having a preference for the belly of the curve, but overall leaning on duration in Europe and other tactical opportunities that we can talk about.
Basically, is it then your assumption that the European rate cutting cycle looks something steeper than that of the U.S., or maybe equally as steep? Because it is an American Fed that started with a 50 basis point cut, while the ECB has had a slower start.
Yeah, I mean, I do think so. As I said, the ECB is now signaling that they're going to pick up the pace. It's going to be the first month-on-month cut that they're going to announce probably tomorrow. But I think it's also about kind of understanding that the reason for the next cut is going to be to fight growth. It's not going to be to fight inflation. So a very different rationale for where cuts are coming from between Europe and the US at the moment. But having said that, I think the overall picture that we're seeing in terms of markets and what investors are doing, we do see significant money in motion that has really started earlier in the summer. I mean, if I look at bond ETF flows, we had a record quarter in terms of people, kind of investors moving back into fixed income, trying to lock in yields before we see the descent of interest rates picking up the pace. And of course, like looking for relative opportunities in Europe, in the US, in parts of the credit market, which I think is very interesting right now.
Yeah, it's that reinvestment risk we've heard so much about. But the credit market itself, I mean, it could scarcely be more optimistic. Spreads are so tight, and any sort of these bouts of risks we've seen in other assets, it hasn't really showed up in credit. Vasiliki, how much of that is resilience versus complacency?
I think the story about credit and what credit offers in portfolios right now, I think it's twofold. There is a very powerful carry component. I know you asked me about spreads being tight, but if I look, for example, at the Bloomberg Global Ag this year, nearly 80% of the returns in the bond market this year are coming from carry as opposed to capital appreciation. If I look at places like European investment grade, nearly 85-90% of the returns are coming from carry. So the income back into fixed income is driving returns, so that's very important. And then the risks that you asked me about, I cannot foresee anything significant happening in the market that would cause a spread widening to happen at a big scale right now. I mean, the global growth is holding up. Central banks are cutting rate. This is a good environment for quality assets. And again, within the different markets, we do have a preference for European credit versus US credit.
Well, you compare the steadiness with credit with what's been happening in the Treasury market, Vasiliki, this oscillating back and forth between different narratives, from inflation concerns to recession concerns to now no landing seems to be the current narrative. But within that, you have this type of bond market volatility that has really captured markets this year. What does that mean for bonds in their traditional place as sort of a staid asset class for diversification and protection in a portfolio?
That is a great question, Danny. And indeed, if you think about US Treasuries, I think the diversification benefits that you get from Treasuries, I'm not going to say they're absent, but I'm going to say they're not so reliable anymore. I think on the longer end of the curve, if you look at 10-year and above, I mean, the fiscal uncertainties are only going to rise regardless of the election outcome in a couple of weeks' time. And if you look at the front end of the curve, I mean, I do think it's much more fairly priced today than it was maybe back in August with the inflation data that we got and the strong NFP. But between now and a couple of weeks' time, you have, again, NFP numbers, you have election, you have another Fed meeting. So I think I'm not going to be buying the 2-year right now. And I think, as I said earlier, if you are considering where to spend your fixed income budget between now and year end, I would lean into spread assets. And this is what we're also seeing from bond ETF flows. The acceleration in IG credit flows into ETFs has been quite significant the last couple of weeks and months.
When it comes to emerging market local FX bonds, how do you view a cutting rate cycle from the Fed that helps them, but then also that threat of the election that you were talking about, the threat of increased tariffs, of Trump yesterday talking about 2,000% tariffs on cars coming in from Mexico? How do you weigh the two pulling factors?
Yeah, that's a very interesting question. So emerging market debt as an asset class, let me start by saying it has been significantly under-owned for many years. So the investment positioning argument is not there, but that hasn't precluded the asset class doing really well this year. I think hard currency emerging market debt is probably the best performing fixed income asset class in 2024. And now that we are seeing kind of the Fed being into a cutting cycle, and again, global growth overall holding up, this is an environment that emerging market debt can do well. Of course, risks do exist, but again, taking cues from history over the last couple of years, we've seen emerging markets being much more resilient in the face of adversity. So I do think emerging market debt is interesting for income and diversification, but again, selectivity is key.
Vasiliki, really great to get your thoughts this morning. Thank you so much for joining us. That is Vasiliki Pachatouridi of BlackRock. Okay, to some other stories that are trending on the terminal this morning. UK inflation has slipped below the Bank of England's 2% target for the first time in 3.5 years. CPI came to 1.7% in September. That is cooler than expectations. The pound weakened. Money markets, meanwhile, boosted wages on back-to-back cuts in November and December. The International Energy Agency is predicting that the world will enter an era of cheaper energy prices. In its long-term report, the IEA said supplies of oil and gas will climb and demand for fossil fuels will cease to grow in this decade. Meanwhile, the surge in electricity use will continue on. And Ken Griffin has found a buyer for one of his luxury properties in Chicago, but at a loss. The Citadel founder's penthouse went under contract for an undisclosed amount, according to Zillow, but it was listed for $11 million in July. Griffin had bought the property for roughly $21 million in 2017, that according to Cook County records. He never lived in the 38th floor residence, and it was marked as unfinished. Coming up, we're going to take you to the chipmaker plummet, ASML sales warning, and a premature release of their earnings. We're going to talk tech next on your Bloomberg Brief. It's your Bloomberg Brief. Danny Berger here in New York. An accidental earnings release and a $420 billion sell-off. ASML sparked a global rout in tech after it posted a tepid outlook, tempering enthusiasm for AI and semiconductors. NVIDIA also selling off in the aftermath of that. Let's get over to Bloomberg's Tom Marenzi on this. Tom, what did the earnings show us, and why such a bad reaction, the biggest sell-off since 1998 for ASML?
Yeah, look, Danny, this was absolutely brutal in terms of the numbers that came through and the stock reaction, as you say. Really crucial is what it tells us about that AI demand. And I think there's a big question mark over that. But in terms of the numbers, they came through. The most recent sales in terms of orders of 2.6 billion euros, well below, less than half the estimates of 5.4 billion. And crucially as well, they cut their guidance for the fiscal year of 2025. They now see potentially sales of between 30 to 35 billion euros. They had seen 40 billion euros. The finger of blame pointed by executives at ASML at industrial demand, so soft industrial demand, soft demand in terms of chips that go into automakers as well. The newly installed CEO, Christophe Fouquet, saying, and I'm quoting, "The recovery is more gradual than expected. It will continue in 2025. Customers are cautious." And by customers, think of Intel cutting costs, but also over in South Korea, SK Hynix and Samsung, two other major customers for this equipment. Of course, the lithography equipment that ASML produces, they are also more cautious. But let's not forget that he did say that there is still some optimism around the AI story.
Tom, I just want to go over this headline that came in late yesterday. Qualcomm is said to wait for a U.S. election to decide on whether or not to buy Intel. What are they waiting for, and what does it tell us about the potential political environment we could be entering into after this election for tech?
Yeah, look, it's a real reminder, isn't it, of how political uncertainty affects business decisions. And this would be a major business decision with major consequences for the US economy and the global economy as well. Qualcomm reportedly then looking and weighing up a potential bid for Intel with all the challenges that Intel, of course, faces. And we touched on part of them in terms of cost cutting and reducing their plans and their ambitions around building out their own foundries in the US. They are clearly, Qualcomm wants some clarity in terms of who the next president will be and how they lean on antitrust. And we know the Biden administration's antitrust push has got teeth. We've been reminded of that in recent weeks around the scrutiny of some of the big tech players. They want some clarity as to who's going to be in office. They may wait then until post-November the 6th, or even push it back until January when the new president, of course, is firmly in the hot seat. So that seems to be a consideration. They've also reached out, interestingly, to regulators in China, a crucial market. Big sales of Qualcomm into the Chinese market and Intel. They want to get some assurance from China as well in terms of their anti-competitive push. So far, the Chinese have stayed muted because they want to know that this deal is really in the offing.
Yeah, a lot of factors to consider. Tom, thank you for walking us through them. Bloomberg's Tom Marenzi. Another set of earnings that also disappointed yesterday, LVMH. This morning in the European trade, shares down some 3.2%. Sales of fashion and leather goods fell for the first time since the pandemic for the French luxury giant. Let's get over to Bloomberg's Caroline Conan on this. Caroline, first of all, great to see you. LVMH had been one of those luxury companies that had been resilient during some of the downturn for the others. Why the change in fortune?
Yeah, and usually they are resilient because they have 75 brands, but clearly even the strongest brands are impacted by the slowdown in China. And today, shares earlier were actually losing as much as 7% for LVMH. They missed in every single unit. If you take fashion and leather, obviously that includes Louis Vuitton, the sales in that fashion and leather unit down 5% in the quarter, much worse than expected, and actually the first actual drop since 2020, the pandemic. The Chinese consumer clearly is still reluctant to buy these expensive handbags, and the recent stimulus that we've seen in China is not actually quite yet reflected in the third quarter. The other divisions, as you can see, wines and spirits also getting smashed, minus 7% in the third quarter. Consumers are buying less champagne. In fact, the harvest has also been very bad recently for champagne, and cognac makers also are suffering, and they're going to suffer perhaps even more with these new Chinese tariffs on cognac makers, which is a retaliation from the EU tariffs on Chinese EVs that we have seen over the past few days. So very bad set of sales numbers for LVMH in the third quarter. In China, in the US as well, analysts were expecting a pickup, and in the US, actually, sales, there was zero growth there.
Caroline, thank you so much. That's Bloomberg's Caroline Conan in Paris. Just another quick earnings to check on. We had a lot of the big banks yesterday. Citi and Goldman shares both dropped in the trade. Bank of America, the sole one that could end the day higher. That was despite trading across the board looking really strong for these companies. Citigroup had their third best quarter performance in at least a decade. So again, all those reported, but now all eyes turn to Morgan Stanley. We'll get those results before the bell. Again, Morgan Stanley shares up about 0.25%. People are going to be watching out for what their trading looks like, how big of an impact that robust stock market also had on their wealth management unit. Okay, coming up, we're going to bring you part of our exclusive interview with the former President Donald Trump. That's to come. This is Bloomberg. It's Bloomberg Brief. I'm Danny Berger in New York. Let's get you some front page news, just a look at what's making headlines around the world. First up, the New York Times leads with this, that the U.S. is warning Israel to increase aid to Gaza or face consequences. The warning was sent in a letter on Sunday to two top Israeli officials. According to that letter, failure to allow the delivery of more aid within 30 days could trigger a cutoff of U.S. military aid. Next up, we have this on the Bloomberg. Harris says that reparations for Black Americans deserve a review. The vice president spoke on the need for the issue to be studied in response to a question during an audio town hall. She also urged Black Americans not to be fooled into sitting out of the race, echoing similar comments from former President Barack Obama. And the Washington Post leads with this one. Elon Musk has given $75 million to his Own America PAC in a push to elect Donald Trump. Musk's contribution is part of a larger wave of fundraising hauls that were reported on Tuesday. Kamala Harris's primary fundraising, for its part, the vehicle announced that it had brought in $633 million, 5 times more than the main Trump fund. Let's stay on the Republican nominee because Donald Trump spoke about his economic plan with Bloomberg editor-in-chief John Micklethwaite at the Economic Club of Chicago yesterday. Here's some of that exclusive conversation.
Because we're about growth. She's got no growth whatsoever, and we're all about growth. We're going to bring companies back to our country. You look at even today, as I was driving over, I see these empty, old, beautiful, like steel mills and factories that are empty and falling down. Some have been converted to senior citizens' homes, but that's not going to do the trick. And we're going to bring the companies back. We're going to lower taxes still further for companies that are going to make their product in the USA. We're going to protect those companies with strong tariffs, because I'm a believer in tariffs. I'm not sure that you are. I don't think you are, but I congratulate you on your career. But to me, the most beautiful word in the dictionary is tariff. And it's my favorite word. It needs a public relations firm to help it, but to me, it's the most beautiful word in the dictionary.
Tariffs, do you think that will bring in the revenues? To use another bipartisan group, Peterson Institute, they say they only bring in $200 billion. That is that's barely the cost of 2 of your promises.
Yeah, but that's like, for what company are you talking about, okay? Look, I've brought in with tariffs, and I was just getting started. Then COVID came, and we had because I tell you what, I did a very good job in COVID. Nobody knew what the hell it was. I call it the China virus because I like being a little more accurate. But when that came, but we got hundreds of billions of dollars just from China alone, and I hadn't even started yet. But tariffs are two things, if you look at it. Number one is for protection of the companies that we have here and the new companies that will move in, because we're going to have thousands of companies coming into this country. We're going to grow it like it's never grown before. And we're going to protect them when they come in, because we're not going to have somebody undercut them.
Former President Donald Trump not backing down from a protectionist agenda, saying that tariff is the most beautiful word in the dictionary. Interesting. Marco Popic of BCA Research saying that maybe Trump is angling for more of a Nixonian grand bargain with China rather than taking a McKinley-type trade war fight with China and trying to win it. We're going to have more on that interview and politics later in the show. A quick check on your bond market this morning. UK yields plummeting. The front end is down 10 basis points, 10-year down 8 after UK inflation coming in below 2%. Does that mean the BOE is going to switch to the dove mode? They have a meeting, and we'll get comments from Andrew Bailey next week, but that's leading to a rally throughout sovereign bonds this morning. U.S. 10-year yields down nearly 3 basis points. Coming up, consumer debt delinquencies, fears those are at their highest since 2020. We're going to discuss with Garrett Melson. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Tech tanks over $420 billion wiped off of global chip stocks after ASML slashes guidance. And it's all about growth. Former President Trump defends his economic plan in an interview with Bloomberg. We'll have more on that exclusive conversation. And Morgan Stanley set to wrap up a strong earnings season for the biggest banks on Wall Street. Well, we are back off of the record highs, a rare bit of weakness. It was led by tech yesterday. S&P futures, little change to slightly lower, slightly higher for NASDAQ as Russell 2000 futures move higher, probably thanks to lower bond yields. It was ASML that badly hurt this market. It is down again in the trade in the Netherlands. Again, its worst day since June 1998 after a weak earnings report. For the global bond market, it's being led by the UK. Rates are moving lower across the board. Inflation back below 2% in that region. You can see cable at the bottom of your screen falling around 130 because of that, but also lower oil prices helping this bond market too. We got some data yesterday. The New York Fed's latest survey of consumer expectations showed that debt delinquency expectations moved higher again. The mean probability of not being able to make a minimum debt payment over the next 3 months has risen to 14.2%. That is the highest since April 2020, at the height of the pandemic. Joining us now is Garrett Melson, portfolio strategist at Natixis. Garrett, I wanted to bring this specific piece of data to you because you are long discretionary stocks. How are you viewing the consumer at this moment when you have pieces of data like this, and again, data like that from the banks showing some strength?
Yeah, well, thanks for having me, Danny. I think it's a story of a bifurcation, right? And I think what we hear quite a bit in a lot of the narratives is that there is some cracking going on with the consumer. And this has been a story we've been hearing for what seems like years at this point. But when you take a look at what actually drives consumption, yes, we do see some weakness at the bottom income cohorts, but that tends to only represent, less than 10% of the consumption basket. So it matters, but it matters at the margin. And when you look more broadly at the consumer, you continue to see a story where jobs remain pretty healthy, a labor market that, even if it has softened, remains pretty strong. Wage growth continues to normalize, but remains healthy. And as long as consumers have incomes to spend, you're seeing that consumption remains pretty well supported here. As the Fed continues to ease, you're probably going to start to see some of that consumer debt come down as prime adjusts lower. All that, I think, continues to be supportive of the consumption backdrop. And discretionaries have been, quietly underperforming for quite some time here. If you look at it on an equal weighted basis, starting to perk up a little bit more recently.
Garrett, it still, though, is a market that's more concerned about the labor market than inflation. You saw that when we had CPI and claims out at the same time. Bostic yesterday was speaking, though, and said, I actually think we're going to see inflation be choppy, and I expect that we'll see employment stay robust. Even if it's a market that's concentrated on labor, is this a Fed that, after the strength of the previous reports, is still concentrated on inflation, maybe more so than weakness to come for this labor market?
Yeah, I think with some of the recent Fed speak, it's not surprising to hear a little bit of pushback and I guess suggestions that the committee is open to a pause. But at the end of the day, this is Powell's Fed. I think that's very clear from the decision to go 50 at the September meeting here. So it is still clearly, I think, a Fed that sees labor markets as kind of taking control of the mandate at this point. Now, maybe some of the data suggests that the balance of risk is is not quite skewed as far towards the labor side of the mandate as maybe markets had thought coming into this over the last couple weeks or into that September meeting. But I think at the end of the day, you continue to see durable signs of inflation returning to trend. Yes, it might be a little bit choppy to get there or back to target. But at the end of the day, the bigger risks are for inflation to remain skewed to the downside and unemployment to remain skewed to the upside. And I think that gives them enough cover to continue easing even if it is a little bit more modest of a pace. And that ultimate destination is a little bit higher than we previously thought just a couple of weeks ago.
But in the near term, Garrett, we are dealing with a fog of data, a data that's being impacted by strikes, by hurricanes. I was speaking with Andrew Hollenhorst of Citi last week, who basically said we won't understand any true trends for months, that it's going to take months for the fog to disappear. Garrett, what do you do in the meantime?
Exactly. And I think that factors into the balance of the risks and how the Fed kind of feels out the right path for policy moving forward. You're going to have a lot of macro noise over the next couple months. You have the distortion from Boeing strikes. That's been a pretty important contributor to equipment investment over the last couple quarters here. And namely, the effects of the hurricane. So when you kind of factor these all together, add in the fact that you're continuing to see rates kind of hold back the housing market, you can find this story where there's a potential for an air pocket in some of the data with a lot of noise on top of that. And so ultimately, I think that skews the Fed towards being a little bit more cautious. And from my perspective, given that balance of risk, that still suggests that inflation is probably not a key concern, and we really need to be focused on the labor side of the mandate here. I think that's another reason to support why they'll continue to modestly recalibrate policy and just continue with 25 basis point cuts per meeting here.
For what it means for equity markets, having this confused macro signal, Savita Subramanian over at Bank of America says that it's muddled macro. Stock picking matters again. It's difficult just to buy an index. You need to look at idiosyncratic stories. Garrett, especially as we're entering earnings season, we're most of the way through the banks. How are you viewing individual opportunities versus investing in sector stories or at an index level?
Yeah, well, I think the story for this year has certainly been one of a pretty good stock picking environment. But even when you kind of peel back the layers, we've talked quite a bit about the Mag 7 and its contribution to performance. But the broader market has certainly seen an increase in participation over the last couple of months here. And that's certainly something we want to see. I would actually say that, yes, you have some of these downside risks. You have that potential for an air pocket in some of the data, put into some of those risks I mentioned, the fact that a lot of companies are basically hitting the pause button right now until after the election. So all of those are risks. But I think what you're seeing is that a lot of the data flow suggests that maybe those downside fears were a little bit overdone here. A lot of the labor market cooling is simply a story of normalization. And things are on a little bit more solid footing than we'd feared. So from that perspective, good news is good news because that continues to suggest that the economy is holding up. Revenues and earnings continue to be supported. And if we do start to see some weakness in data, I think that just means that the Fed's going to be stepping up a little bit more aggressively here. So it's kind of a heads I win, tails you lose dynamic here. And I think that's going to continue to be supportive of risk appetite and ultimately help to support the broader indices. So while I think it's a good environment for stock picking, I actually think it's a pretty good environment for maybe a rising tide dynamic. Yes, there's short-term risk with the election uncertainty, but beyond that, I think the macro backdrop is still very supportive. Growth's holding up, labor markets are holding up, the Fed and global central banks are embarking on a synchronized easing cycle. And at the end of the day, I think that's going to continue to support upside earnings revisions.
Garrett, this was really excellent. Please come join us again. Garrett Melson of Natixis. Thanks for getting up early. This is Bloomberg. It's your Bloomberg Brief, Danny Berger in New York. Morgan Stanley will be wrapping up the big bank earnings later this morning. That's after some strong results, but mixed reactions from its peers. Take a listen to what Goldman CEO David Solomon said yesterday on the earnings call.
We have deep, deep client relationships, clients who rely on us for a package of services, and that's not going away. Certainly in this environment, this is an environment that's filled with uncertainty. Their need to constantly be engaging and, repositioning and reshaping, continues to make them, very, very active on a broad global scale.
Solomon there hinting at the stock trading bonanza for Goldman Sachs and others. Joining us now is Octavio Marenzi, CEO and co-founder of Opimas. Octavio, always great to see you. So we had really strong trading results. Net interest income, for the most part, not as bad as feared. Yet a muted response in Goldman shares and Bank of America shares, especially compared to JP Morgan the Friday before. What did you make of the results we've gotten so far?
Well, it was sifting through these financial results. I think in most cases, actually better than were expected. So the loss provisions they set aside in most cases were better. There was an improvement there. Net interest margins not deteriorating, and in some cases actually even improving. I think someone like Wells Fargo, I think, was a particularly interesting one, where they basically reduced their loss provisions and saw things actually improving, despite the fact that they have a very big exposure in terms of things like commercial real estate. So those, I think, were the interesting things. But I think what is most interesting about it is what it actually says about the broader US economy, because the net charge-off rates and loss provisions and things of that sort remain quite muted, even on the most sensitive areas of those portfolios, which tends to be the credit cards. And so at the first sign of trouble you see in the US economy tends to be there in the credit card portfolios and the charge-offs there. And they remained very muted. We saw things varying between 3.8% and 4.2%. Now that sounds like a lot to lose every year, but bear in mind, historically, we've seen things much, much higher. So that's inching up slightly, but still pretty low. So I think it speaks to the robustness of the US consumer. I think the US economy overall is looking really good. And the talk of a soft landing looks like a very, very soft landing, if a landing at all.
Oh, no, we're going to get into the landing definitions, aren't we, Octavio? Just park that to the side for a moment, because that's a whole other conversation. You did see, though, loss provisions raised for both JP Morgan and Bank of America. Are they doing it from a place of strength, Octavio, because they can, or because there are concerns for them on the horizon?
Well, the loss provisions they set aside is always a bit of an art more than a science, I think, in terms of how to make those determinations and how much they're going to put aside. But I think they're doing it from a position of strength, basically. So they've seen the underlying charge-offs not increase that much, but say, OK, we should put some more money away there. There might be some softening in the economy in our forecasts, and therefore we're going to put these loss provisions aside. If it doesn't come into being, we don't actually make those losses, well, we can reverse that and then reduce our provisions and have a nice boost to our net income. So I think we'll probably see that a bit later down the road. But the actual real losses on the portfolios, really people not repaying their debt, remains very, very low and very, very manageable. So that's a very encouraging sign. But so, yes, they're doing this from a position of strength, setting money aside for a rainy day, but I'm not sure it's absolutely necessary for them to do that at this stage.
Octavio, what did you make of Citi? Not even just the results themselves, but the reaction. They come out, again, equity trading is really strong for them. Pre-market shares are higher. And throughout the day, you end up getting a pretty vicious sell-off that ends in down 5%.
Well, as I was looking through the earnings that came out, we were sort of sifting through them and saying, what's happened here? I think you saw pretty flat revenues, expenses down slowly, somewhat of an increase in terms of loss provision. So overall, it was a bit disappointing, the results there. Couldn't really figure out why the market was rewarding Citi for these results. I don't say they were mediocre. They were somewhat lackluster, I think, overall. Very, very hard to say why in the pre-market it went up and then it got punished later on in the day when the markets were open. So I'm not sure why that particular thing occurred there. But I think if you look at Citigroup as a whole, they've been in sort of a restructuring exercise for the better part of a year now. The CEO, Jane Fraser, had announced basically taking out whole layers of management, restructuring things, reorganizing them, and taking away a lot of the redundant management layers that were within Citibank. And I would have expected to see a bigger impact in terms of cost savings at this stage in that transformation. So we saw a fairly tepid reduction of 2% overall in operating expenses, but you can achieve that very easily by just having a hiring freeze and just letting natural attrition run its course. So a 2% reduction in operating expenses is not what I would have hoped for Citibank. I would have expected to see greater dividends being paid from this massive restructuring exercise they've gone through. And I think the market looked at that and is a bit disappointed by that overall, that is not having its effect. Bear in mind, Citibank's stock price, or Citigroup, sorry, has had a big run up over the course of the past year, mainly on the back of the promise of this big restructuring effort that's underway.
Octavio, I got to squeeze this in. Where does this all set the bar for Morgan Stanley when it reports in a little less than 2 hours' time?
Well, I think they're going to do really well. So if you look at the businesses that Morgan Stanley is in equities trading, in fixed income trading, in asset management, wealth management, all the results at the other institutions were pretty strong there, particularly in equities trading, where they've got a nice franchise. So that should do fairly well, I think, overall. So I'm expecting to see do really well, strong top line growth. I think the real question is, what are they happening on the expense side? Are they able to contain and control their expenses? We saw Goldman Sachs do a very good job there. I would expect to see that replicated at Morgan Stanley. So we shouldn't see a big boost. I would say over a 50% increase in terms of their net income for the quarter compared to last year. So I'm expecting good things from Morgan Stanley later on today.
Octavio, wonderful to get your thoughts. Thank you for joining Octavio Marenzi of Opimas. And tune in to our interview with Morgan Stanley CEO Ted Pick. That'll be at 10:30 a.m. on Bloomberg's Open Interest. We're also counting down to the U.S. presidential election, now less than 3 weeks away. Both candidates continue to highlight their economic plans as the main focus of this election and their discussions. Former President Trump sat down with Bloomberg's John Micklethwait at the Economic Club of Chicago. Take a listen.
We're all about growth. We're going to bring companies back to our country. We're going to lower taxes still further for companies that are going to make their product in the USA. We're going to protect those companies with strong tariffs, because I'm a believer in tariffs.
That was Bloomberg's exclusive interview with the Republican presidential nominee Donald Trump in partnership with the Economic Club of Chicago. Joining us for a look into the economic futures under Trump and Harris is Anna Wong, chief U.S. economist of Bloomberg Economics. Anna, thanks for joining us. I know you were up yesterday also keeping track of that conversation. It's two very different worlds that these candidates are proposing. For Trump, it's a lower corporate tax rate to 15%. For Harris, it's a higher corporate tax rate to 28%. Just how big of a gulf are we talking about the economic future for America under either candidate?
Yeah, so Trump is all about tax cuts, except when it comes to tariff. A tariff increase would be a form of tax increase. Harris campaign, aside from the corporate tax hike that she's proposing, so she's proposing to raise the corporate tax rate from 21% to 28%. She's also implicitly proposing to raise taxes on the upper income. So if TICTA were to expire at the end of 2025, the marginal tax rates of the top income would go back to 39.6 from 37%. So effectively, tax rates would be increased under Harris. And so, whereas under Trump, if he were to be able to make all the personal tax cuts under TICTA permanent, then all Americans will see their marginal tax rates remain at where they are. Another thing that's different about the two candidates, of course, is for Harris. Harris supports raising the tax rate on unrealized capital gains for the wealthy to 25%. That would be quite substantial because the wealthy are not taxed on the unrealized capitals right now. Furthermore, another big difference is child tax credit. Harris proposed to increase the child tax credit to $3,600 per child and even $6,000 for a newborn, whereas under TICTA, if TICTA were to expire, it would have child tax credit would go down from the current $2,000 to $1,000. So that's another big difference there.
There's so many things, though, of course, that are hard to figure out because they'll need congressional approval and things like that. But Trump really doubling down, not just on tariffs yesterday with John Micklethwait, but continued to drive this message that it is growth, calling the U.S. a developing market, that it needs growth-like policies. How do you understand how the policies will actually impact growth?
Yeah, so I see the holistic nature of Trump's tax policy as very similar to his first term, which is he thinks that by relying on tax cuts, that pro-growth, that growth-enhancing impulse would more than offset the growth reducing impulse of the increase in tariffs. So our models suggest that all the tax cuts would generate about 0.3% boost to GDP by 2028, whereas Harris' policies, if she were to be able to pass all of them, would be reducing growth by 0.1% of GDP by 2028. That said, the tariff increase under Trump will more than offset that 0.3 percentage boost to GDP growth from the tax decrease by our estimation. Also, another factor to consider is how much of these proposals are likely going to be passed. So in consultation with our colleagues at the government affairs side, we thought that the plausible policies would basically water down both candidates' tax policies to be about roughly the same. And ultimately, the GDP impact of Trump's plausible tax policy would only boost growth by 0.1% by 2028, whereas Harris' plausible policy would be essentially left GDP growth unimpacted.
When it comes to things like his tariff policy, Adam Posen has long said that it could even mean that you see a Fed that hikes next year. Anna, what have your models shown about possible inflationary regimes under the candidates?
Yes, so most economic models would say that tariffs would boost inflation. So our models thinks that it would be, if all of Trump's tariffs were to pass, which is 60% tariffs on China and 20% the rest of the world, that would boost inflation by 1%. It could be 1 percentage point, more than 1 percentage point in the first 2 years. But that said, I think Trump did make a valid point in pointing out to how in his first administration, his tariffs didn't generate a big inflation impact. And that's because the economy responds to tariffs in two ways. One, either firms can pass through those tariffs to final prices, which generate into inflation, or they could just reduce profit. And we saw the latter in the first Trump administration.
Anna, thank you so much for your insight. Anna Wong of Bloomberg Economics. All right, coming up, we're going to set up your trading day, Morgan Stanley results, and we have an exclusive interview with Druckenmiller. All that to come. This is Bloomberg. Welcome back to Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Wednesday. Morgan Stanley will be reporting its third quarter earnings before the bell. And then tune in to our interview with the CEO, Ted Pick, at 10:30 a.m. Eastern. A lot of important conversations. We'll also be speaking with the Duquesne founder, Stanley Druckenmiller. That is at 12 p.m. Okay, some of your individual movers this morning. Intel falling nearly 3% in association backed by Cyberspace Administration of China, suggests a check on Intel products due to cybersecurity risks. Interactive Brokers down nearly 5%, extending its declines after a miss on its earnings. Finally, Cisco there, Citi upgrading it to a buy, citing that AI is benefiting the firm's top line. Quite a different fortune for different chip makers. This morning, you're also seeing bond yields come in, led by the UK after inflation coming in below 2%, down 8 basis points. Your 10-year yield down 2.7. Okay, that's it for your brief. Surveillance, they'll take things from here.